Velan, symbol VLN on the TSX, is a world-leading producer of highly engineered industrial valves, not just your normal tiny little valve. They're huge ones for stuff like nuclear reactors. They're the size of a person, many of them. The company serves various industries, including power generation, including nuclear, oil and gas, refining and petrochemicals, chemicals, LNG and cryogenics, pulp and paper, geothermal processes, and shipbuilding. The stock is currently trading at about $5.60 a share with a 120 Canadian market cap, being down roughly 5% year to date. However, the stock has had a much more eventful year than just a 5% change would imply. In February 2023, the shares skyrocketed to just under $13 a share following the announcement that Flowserve, symbol FLS on the New York Exchange, was to acquire Velan at $13 a share, representing about a 100% premium to the prior day's trading, and it was already up a bit at that point, so compared to 30 days prior, it was well past even 100%. The acquisition was expected to be accretive within the year, as Flowserve expected $20 million US in cost synergies within the first 2 years, and it was expected to be accretive on adjusted EPS within the first year. Flowserve expected to leverage its network of customers with Velan's product stack, which is why it expected significant synergies as well, which in turn resulted in the high acquisition premium, with the expectation that the deal would close within Q2 of 2023. However, that did not happen. The acquisition was not to be. First, in August, the company announced that it had an extended timeline for the acquisition, causing the shares to drop to about $10 or so, as regulatory approvals had not been obtained at that time. Then the death blow occurred in early October with the French regulators denying regulatory approval and would not approve regardless of any remedies that Flowserve could provide. The core reason is French regulators did not want a sale of a supplier for nuclear reactor parts coming under control of a US company, but they did know that there were other factors besides nationality, but that was the big one. That caused the shares to fall back to the current range, about $5.60. So, without the deal, does Velan have any value as an investment? During fiscal Q2 2024, which ended August, so you're looking more at the first half of 2023, the company had sales of $80.3 million, which is 18.7% higher than Q1, but 5.6% lower than Q2 23. Looking at a longer period of time, sales have been just relatively flat, but with quite a bit of volatility. I have a graph up which it goes back 20 years, and you can see it's been relatively flat, but year over year and quarter over quarter, you do have quite a bit of variance. GAAP loss per share, so EPS, was 10 cents versus a loss of 17 cents in the prior year. Similarly to revenue, we've seen really no progress on EPS over the past 20 years. In fact, it has deteriorated, if anything. We've shifted from where it's been previously profitable on a GAAP standard to now a loss relatively consistently. The balance sheet is relatively strong, but it's been deteriorating as they have been accruing those losses. The company has a net debt and leases position of $7.1 million, with significant additional liquidity available through its credit facilities. The company does have lumpy cash flows as time is a payment and much of that is prepaid by customers, which is a positive when it comes to cash flow management, but it is still lumpy as they are generally large sales. They'll receive the payment up front and then nothing is really received from that customer after that, but it might take a year to produce the product. But like the revenue and the EPS, cash flows, and EBITDA as a product have had no sustained growth over the past 20 years, or quarter over quarter, year over year. It just hasn't been sustained. As well, a major factor posing risk for the balance sheet is the company has they added an additional $56 million legal provision for lawsuit settlements, which related to its previous use of asbestos in its products. The significant increase is because the company is now accounting for unfiled lawsuits based on their expectation of additional lawsuit settlements in the future. So really, it's a actuarial expectation, so it can change quite a bit. It could end up being quite a bit higher, or it could not be realized at all. It's not an actual cash expense at this time. It's just what they are estimating it could be. So quickly looking at valuations, as the company does not have positive GAAP earnings, we're going to look at adjusted EV/EBITDA, which removes the impact of the legal provision, which comes out at about 4.4 times. However, if we treat the total 73.3 of the asbestos provision, which they did have some before the latest provision increase, and if we treat that like debt or a reduction in cash, which effectively increases the enterprise value, the EV/EBITDA is 7.7 times. That said, there's no guarantee, like I was saying, that these will be realized. They're actuarial expectations. So they could obviously change. It's really just to see if this is to occur, what would the valuation would look like. So our take after the acquisition of Velan was blocked. The company was just not appealing due to no sustained growth across any metric, a balance sheet that could become significantly weaker due to the expected future settlements, which could potentially increase leverage, of course. Also, you could take a lesson away from this. Holding your shares through a potential acquisition for those few extra percents. Remember, it was trading about $12.70. You go to $13, so you're holding it for that 30-cent increase. It does carry risk. And in VLAN's case, it did materialize the downside risk, so you ended up losing $8 for 30-cent upside. And I'll open up to you guys after that.
Yeah, I mean, I took a look at the acquisition back when it was announced because VLAN's come across my desk as an income stock in the past. And I mean, if I owned it, I wouldn't have owned it based on the fundamentals to begin with, even at the lower price. But if I had owned it, I mean, I would have sold so quickly into that acquisition announcement. I couldn't really understand the numbers in terms of it just didn't make sense. It looked like they were paying a lot for the financial performance that the company was able to achieve. But of course, they're not buying. I mean, a lot of times an acquisition is really based on more of a sum of parts and what that sum of parts is worth to the acquirer. So because it's a company in a similar industry, tangential industry, they're able to acquire customers, technology, other things that they can then integrate. So it's not, maybe to the acquirer, it made more sense, but to investors, I mean, if you owned it, you should have just sold. I wouldn't even own it at the current price.
Yeah, that was the story. It had to be synergies because, and those are always, sometimes difficult to really put a number on. But in this case, yeah, I mean, the company, just even if you look back 10 years, it did 540 million in revenue 10 years ago. Just trailing 12 months is 484. There's not much growth. As Brett said, the cash flow, there is some, it's lumpy. It's there, it's not there. This was a sum of parts valuation. Those are very difficult to do in terms of, from our perspective. Now, an investment in it at this time would only be basically based on you speculating or an investor speculating on a future takeover. It may or may not happen. Obviously, there's some regulatory risk to that happening right now. And at this point, the management has really shown that over the past 10 years, all they've been able to do is produce a decreasing profit. So that's not something that we would look at. There may be a case here that, I mean, a price to sales is like 0.25 or something like that. So if you could get a margin out of this business, there should be an opportunity. You should be able to, like, that's a very low price to sales on this business. You should be able to pull some kind of margin out. But right now, the company has not been able to do that on a consistent basis. So the valuations are low and probably stay in this range until they can focus on producing sustainable cash flow.
I will add as well, since Aaron previously looked at VLAN in his income coverage, they've effectively removed the dividend. They're only paying 3 cents a year, and it was completely removed during COVID. And they were already having issues before that. They dropped it from 10 cents a quarter to 3 cents a quarter, and now we're at the 3 cents a year.
Mm-hmm.
Well, they have no earnings to pay a dividend from, so that would have been a good choice. Unfortunate for their investors.
Yeah, it's interesting to see this share yo-yo up and down this year, but really it's in its current range. And other than like looking at price to sales or an adjusted EV to EBITDA ratio, that's the justification where the price is now. Potentially, based on speculation of another takeover, if they can allay those concerns from the French government, maybe there is a takeover at some point. But that's just pure speculation. We want to buy the business based on cash flow and growing that over time. We're not seeing that here.